We all rely on the oceans to keep the global economy moving, right? But let's be real, the waters out there aren't always safe. Welcome to This Explainer, where we're going to unpack the fascinating, super high stakes financial mechanics that actually protect global shipping from some of the world's most dangerous threats. We're looking at the exact mechanisms that keep international trade afloat, even in the absolute worst case scenarios. So ask yourself, what actually protects a massive vessel carrying millions of dollars in cargo when it literally has to sail right into a war zone? You're probably picturing, naval escorts or heavily armed guards. But the real, invisible shield keeping these ships moving, it's entirely financial. The answer comes down to staggering financial safety nets. We're talking international limits reaching up to $300 million per vessel. Just let that sink in for a second. $300 million for a single ship, just to give the owner enough peace of mind to risk sending their cargo through a volatile strait or contested waters. Without this massive financial backing, global supply chains and all those everyday consumer goods, electronics, and fuel we rely on would just literally freeze up. Okay, let's dive into part one. What exactly is war risk? Because we aren't just talking about a bad storm at sea or, a routine engine failure. War risk insurance covers extreme human-driven chaos. Think acts of war, invasions, insurrections, rebellions, and hijackings. Some of these policies even extend to cover damage from weapons of mass destruction. And the premium a ship owner pays for this? It is completely dependent on the expected geopolitical stability of the places that vessel is heading toward. When insurers actually structure this protection, they split it into two crucial halves. On one side, you have war risk liability. This covers the people and the cargo inside based on a specific indemnity amount. And then on the other side, you've got war risk hull. This protects the physical vehicle itself, the actual metal in the water, calculated based on the total value of the craft. You really need both for total peace of mind. And here's a wild detail, the detainment clause. Let's say a vessel gets captured or seized by a foreign power. If that ship is held for 12 continuous months, it's legally deemed a total loss. That means the owner is officially deprived of their property with zero likelihood of getting it back, and the policy pays out in full. All right, moving on to part two, the Indian government scheme. If we trace the evolution of the Indian scheme, we see a pretty massive shift over the decades. Back in 1976, the government introduced a plan to provide marine hull insurance through domestic companies. Fast forward to 1993, they amended it to adapt to changing times. But the real game changer happened in 2005, when the Insurance Regulatory and Development Authority fully de-tariffed marine hull insurance, basically signaling a huge leap toward a liberalized, open market. Under that original 1976 setup, ship owners could voluntarily insure their marine hulls, knowing the coverage was 100% reinsured by the government itself. Sounds great, right? But the catch was that the government maintained absolute control. They could revise your premiums at any time or even cancel your policy with just 14 days' notice. That is a genuinely terrifying prospect if your ship is already halfway across the globe carrying a fortune in cargo. Plus, having this coverage wasn't just a free pass to sail wherever you wanted. The scheme had really strict geographical trading exclusions. For instance, heading to ports in Iraq meant paying a hefty extra premium. And trading in Pakistan waters? That was strictly capped at just 7 days of coverage, and you had to get prior approval to even do it. Which brings us to part three, liberalizing the market. So historically, the government only collected a tiny peacetime premium, just 0.08% per year on the ship's market value. But as the market finally opened up, the General Insurance Corporation, India's official reinsurer, took over. And when they did, they injected a staggering 400 crore rupees of extra capacity. This was designed specifically to give the domestic shipping industry a much stronger safety net against international risks. This whole process culminated in complete market freedom. The old, strictly government-run system was tossed out. As of January 1st that year, all general insurance companies operating in India were free to underwrite war risk on marine hulls themselves, as long as they followed regulatory guidelines. Practically overnight, domestic shipping finally had the robust backing it needed to take on international waters with total confidence. Now, let's look at part four, international standards and piracy. When we zoom out and look at modern international shipping as a whole, the jump in scale is just mind-blowing. Under the old Indian domestic scheme, protection and indemnity risk was capped at 10 crore rupees for any single event. But on the international stage, The total sum insured for a single vessel can hit up to 300 million US dollars. That is an absolute quantum leap in the kind of financial firepower required to keep global shipping lanes open. And international coverage is incredibly comprehensive. Owners can claim up to $25,000 every single day just for unavoidable extra expenses following an incident. Also, remember that 12-month domestic detainment rule we talked about earlier? Well, internationally, under the blocking and trapping clause, owners can claim a total loss after just 6 months of being stuck. And then there's modern piracy. When pirates strike, there's a very precise ticking clock known as voyage frustration or piracy loss of hire. If your vessel gets delayed by pirates for more than 48 hours, boom, the coverage kicks in. The owner is then indemnified for their lost time for up to 180 days, with a massive maximum limit of $17.5 million for a single occurrence. However, there is one very strict, absolutely non-negotiable red line here. Insurers will happily pay the costs to prevent or mitigate a hijacking, but the contracts state clearly that this completely excludes any ransom demands. So they will protect the vessel, and they'll cover the lost time, but under no circumstances will they fund the pirates. When you look at the sheer scale of the risks out there, from these multi-million-dollar payouts to the realities of modern piracy, it really leaves us with a vital question. As global supply chains face totally unprecedented geopolitical tensions right now, how are the mechanics of war risk insurance going to evolve to keep our world connected? Next time you order a package from overseas, just remember the invisible, high-stakes financial shields that actually made its journey possible. Keep questioning and keep learning.